There was a time when financial power had a very specific look. It wore tailored suits, sat behind oak desks, and moved slowly through boardrooms thick with smoke and hierarchy. The financial celebrities of that era were tycoons, industrialists, bankers, oil magnates, railroad barons. Their wealth was visible in factories, land, and infrastructure. Power came from owning physical assets and controlling supply chains that could not be easily replicated. Fame followed force. But finance, like power itself, evolves. And as the nature of value shifted, so too did the faces of those who dominated it. To understand the evolution from tycoons to tech moguls is not to study personalities, but to study how money follows leverage and how leverage migrates when technology rewires society. The early financial celebrities were builders of scale in a tangible world: steel, oil, railroads, manufacturing, banking. Their advantage lay in capital intensity. Whoever could raise the most money, control the most labor, and endure the longest could dominate. Books describing this era emphasize endurance over elegance. These figures were ruthless not because they were immoral, but because the systems they operated in rewarded consolidation. Monopoly was efficiency. Size was survival. Visibility was unavoidable. Factories polluted skylines. Railroads cut across continents. Wealth announced itself physically. Financial celebrities were public whether they wanted to be or not. Their power rested on ownership of things that could be seen, taxed, regulated, and seized. Influence was local before it was global. As the 20th century matured, finance professionalized, capital markets expanded, corporations replaced individuals as the primary engines of growth. Financial celebrities increasingly emerged from allocation rather than production. Fund managers, deal makers, conglomerate architects. Their power was quieter. They moved money rather than machinery. Control shifted from owning assets to controlling decisions. This transition marked a subtle but profound change. The celebrity financier was no longer the builder of a single empire, but the orchestrator of many. Influence expanded, while visibility diminished. Financial celebrities learned that power scaled faster when it remained abstract. Money became information. Ownership became optionality. Then technology accelerated everything. The rise of tech moguls did not simply add a new category of financial celebrity. It rewrote the rules of wealth formation entirely. Software collapsed marginal costs. Networks replaced factories. Code scaled faster than capital ever had. Suddenly, the most valuable assets were invisible. Algorithms, platforms, data, attention. Tech moguls emerged not by controlling supply, but by shaping behavior. They did not own the means of production in the traditional sense. They owned the interfaces through which production, communication, and commerce flowed. Their leverage was psychological and networked rather than industrial. This shift explains why modern financial celebrities often look nothing like their predecessors. Hoodies instead of suits, campuses instead of boardrooms, youth instead of longevity. The market began to reward speed over durability, iteration over endurance. Fame arrived faster. Fortunes appeared to materialize overnight, but this apparent overnight success obscures a deeper continuity. Despite surface differences, tech moguls inherited the same fundamental obsession as tycoons: control over bottlenecks. The bottlenecks simply moved, from railroads to operating systems, from oil pipelines to cloud infrastructure, from factory floors to digital ecosystems. Financial celebrities did not abandon old rules, they followed them into new terrain. Another major difference lies in narrative. Tycoons were often feared. Tech moguls are often admired, even mythologized. Innovation softened perception. Disruption reframed dominance as progress. The public tolerated concentration of power when it arrived packaged as convenience. This narrative shift allowed financial celebrities to operate with less resistance, at least initially. Books examining this evolution note a striking pattern. Regulation always lags innovation. Tycoons were eventually constrained by antitrust laws, labor movements, and political backlash. Tech moguls are following a similar arc, though compressed in time. What took decades now takes years. The cycle repeats faster, but it still repeats. Another transformation involves capital itself. Early financial celebrities required enormous upfront investment. Tech moguls often required very little at the start. Venture capital replaced banks. Risk shifted from institutions to portfolios. Failure became acceptable, even celebrated. This tolerance for failure reshaped who could become a financial celebrity. Age, pedigree, and geography mattered less, at least temporarily. Yet as systems matured, capital once again concentrated. Platforms dominated. Winners took most. Financial celebrities re-emerged as gatekeepers rather than rebels. The language remained democratic. The outcomes did not. Power centralized quietly behind familiar apps and services. An important psychological shift accompanied this evolution. Tycoons measured success in permanence. Factories that lasted generations. Railroads that defined nations. Tech moguls initially measured success in growth curves and user counts, but as their fortunes stabilized, their mindset shifted toward durability. Data centers replaced factories. Regulation replaced labor unrest. Governance replaced chaos. The most enduring tech moguls began to resemble old tycoons in one crucial way. They slowed down. They diversified. They invested in infrastructure. They built holding companies, foundations, and long-term vehicles. The costume changed, but the playbook converged. Another key difference lies in how these financial celebrities interact with the public. Tycoons communicated through institutions. Tech moguls communicate directly. Social media collapsed distance between power and perception. This visibility increased influence but also volatility. Reputational risk became immediate. Narrative control became a strategic asset. As a result, modern financial celebrities must manage both markets and attention simultaneously. A tweet can move billions. Silence can be interpreted as strategy. The psychological burden of this dual responsibility reshapes behavior. Power is faster, but more fragile. Looking across eras, one insight becomes unavoidable. Financial celebrities are not products of personality. They are products of systems. When value lives in land, landowners dominate. When value lives in machines, industrialists rise. When value lives in networks, technologists rule. The faces change because the leverage changes. And this is where the story begins to narrow. Because once we stop framing the evolution from tycoons to tech moguls as a story of innovation alone, and start seeing it as a migration of leverage, a deeper lesson emerges. Financial celebrities are simply those who learn earliest where power is moving and reposition themselves before others accept the shift. It is at this point where history stops being nostalgia and becomes pattern that the evolution reveals its logic, showing us not just where wealth has been, but where it is likely heading next. As control moves further from physical assets to abstract systems, from ownership to orchestration, from visibility to influence, unfolding not abruptly, but through repeating cycles of concentration, backlash, and reinvention. Like unfolding not abruptly, but through repeating cycles of concentration, backlash, and reinvention. Like a pendulum that never stops swinging, only accelerating as technology compresses time. And this is where the evolution from tycoons to tech moguls reveals its most important lesson. Power never disappears. It relocates. In the second half of this evolution, what becomes clear is that every generation of financial celebrities believes it is breaking from the past, while quietly inheriting its deepest structures. Tech moguls did not overthrow tycoons. They replaced steel with code, factories with platforms, labor with users, and geography with networks. The surface aesthetics changed. The mechanics of dominance did not. As tech moguls matured, they encountered the same forces that confronted industrial titans before them. Scale invited scrutiny. Network effects triggered antitrust concern. Control over information raised ethical and political questions. Regulation, once distant, moved closer. The cycle repeated only faster. What took tycoons half a century now confronts tech moguls within a decade. Speed has become both advantage and vulnerability. One of the most striking shifts at this stage is how modern financial celebrities respond to pressure. Early tech leaders emphasized openness, decentralization, and disruption. Later, they pivoted toward consolidation, infrastructure, and defense. Data centers replaced idealism. Compliance teams replaced improvisation. Foundations, trusts, and long-term vehicles emerged where hacker culture once dominated. The rebel learned the language of the ruler. This convergence explains why the most enduring tech moguls begin to resemble old-world tycoons in behavior, if not in image. They diversify. They slow growth deliberately. They invest in hard assets, energy, logistics, and finance domains their predecessors once dominated. History does not reverse. It layers. Each era adds a new dimension of leverage while retaining the old ones beneath it. Another critical development is the fusion of finance and technology into a single operating system. Modern financial celebrities are no longer just builders or allocators. They are orchestrators. They control platforms where capital, information, and behavior intersect. This orchestration power is subtle and immense. It allows influence without direct ownership, coordination without command, and scale without visibility. But this power carries fragility. When value is abstract, trust becomes the limiting factor. A factory can run despite public dislike. A platform cannot. Tech moguls discovered that legitimacy is now as important as efficiency. Narrative, ethics, and governance moved from public relations to existential risk management. The celebrity financier must now manage perception as carefully as performance. Another evolution lies in who gets excluded. Tycoons excluded competitors through capital barriers. Tech moguls exclude through ecosystems. APIs, standards, and data access define who can participate. The gatekeeping is quieter, but no less real. Financial celebrities shape the rules of entry, not by force, but by design. As the cycle continues, a new transition is already visible. Artificial intelligence, automation, and financialization of attention signal another migration of leverage. The next financial celebrities may not own platforms but the models that power them. Control may shift again, from networks to cognition, from infrastructure to prediction. Those who recognize this early will appear visionary later. And yet, the deepest lesson remains unchanged. Financial celebrities do not create eras. Eras create financial celebrities. The winners are those who sense where value is concentrating, align early, and adapt when backlash inevitably arrives. They are not smarter, they are earlier, more flexible, and less sentimental about old advantages. This reframing dissolves both envy and idolization. Tycoons and tech moguls are not moral archetypes. They are signals. They tell us where leverage lives now and where it is leaving. Studying them is not about copying behavior, but about reading direction. So the story resolves, not with a name or a net worth, but with a question. If leverage has migrated repeatedly from land to machines, from machines to code, from code to cognition, where is it moving next? And what habits of thinking will be required to recognize it before it becomes obvious? If this reflection resonated with you, pause and ask yourself one question. Are you building skills and assets tied to yesterday's leverage, or preparing for tomorrow's? That answer shapes not just wealth, but relevance. Share your thoughts. And if you want to keep exploring how power, money, and technology evolve together across cycles, stay connected. Subscribe, follow, and return. Because history does not reward those who admire past giants. It rewards those who understand why they rose and where the ground is shifting next.